Hi, everyone, and welcome to our webinar for October, where we'll be discussing the third quarter trends in the diamond industry. My name's Avi Kravitz. I'm an analyst and reporter for Rapaport, and with me is our operations manager, David Ehrlich, and Shimon Gerstensang, who is our involved in our trading and pricing research division. This is our second webinar that we're holding. We're holding them on a quarterly basis, and the idea is to increase our conversation with the trade, with our partners in the industry. And really to gain a better understanding of what's happening in the market on a quarterly basis, especially now. I think it's important as we kind of at a turning point in the trade as we're heading into the holiday season. So a few just what you can expect. So we're going to be the webinar will be about an hour long. I hope to speak for about 40 minutes to 45 minutes, and then we'll give some time for questions. If you do have any questions, both during the webinar and in the Q&A section, please write those questions in the Q&A facility on the Zoom system. It'll be better for us if you don't put it in the chat. It'll be easier to monitor if all the questions are in the Q&A section. So I'm looking forward to sharing with you some of my insights and understanding, or our insights and understanding of the market at this point in time after the third quarter. So let me share my screen with you so that you can follow our presentation as we go along. David, can you see it? Yeah. Great. Okay. So. As I mentioned, this is our second webinar. Our first one was in July, where we looked at the second quarter and the first half of the year. And at that point in time, we were quite optimistic about the industry, about the trade. We had a very positive first half, a very positive start to the year, and that was largely as a result of good holiday seasons, both in the United States and in China. And we were seeing growth in both those markets, both those important markets, for the first time simultaneously in a long time. That influenced a very positive feeling about the industry. In our webinar in July, we spoke about that being supported by some very important moves that the industry was making. That we found that the conversation the industry was having with millennials was more effective. There was a stronger millennial sort of language that was being spoken. There's a greater awareness of the importance of omnichannel, the combination of improving the in-store experience as well as the online experience and the interchange between those two. We've seen a definite improvement in that in the last year. Also seeing an increase in marketing from the likes of the Diamond Producers Association. De Beers increased their budget last year, and we expect them to do the same for this year's holiday season. And that again ties into that engagement with millennials. It's not just a TV ad that's being put out there. It's about a social media interaction, an all-encompassing marketing strategy, and we're seeing some important improvements in that end. And then finally, we spoke about these provenance programs, the attempt to track diamonds through the distribution chain, that improves confidence, improves the storytelling of the diamond industry. And we're seeing a lot of, not a lot, but certainly an increase in that sort of activity. And in fact, in our research report that we're going to be publishing today or tomorrow, we look at those provenance programs that are on a deeper level. But if you fast forward to today, and there's a bit of a different feel about the market. There's certainly more caution and some uncertainty about the third quarter. And so my goals for our webinar today in the next hour is to try and understand some of the trends that are influencing that slowdown in the third quarter, and that is actually carried on through October. We're going to look at some specific categories that have been particularly slow. We look at the Malay market has been weak in 2018. The 30 pointers were weak in the third quarter. And we want to understand what are the factors that are influencing the slowdown in those categories. And as a way of contrast, we'll demonstrate we're seeing some stability in the 1 caraters that we'll also have a look at. And then finally, we'll try and identify some developments that may impact the trade during the important retail selling period. We're going into November, December now, which holds such importance to the industry, and we want to give some understanding of what we might expect from certainly within the midstream. Before we get to it, just a little bit about Rapaport. We are a company that stands for ethical, transparent, competitive, efficient markets. This year is our 40th anniversary. We were established in 1978, and today we're a company with offices in 6 countries, 9 offices around the world, and over 200 people working with us. We're a service provider to the industry, and we're providing a service to over 20,000 clients in over 120 countries. We have 4 business units, or core business units, although we have other activity that's also going on, a lot of other activity. The Rapaport Information Services, which I'm a part of, we publish the Rapaport price list. We have the magazine, the diamonds.net, which provides news to the industry. Of course, there's the Rapaport research report that we publish, and among other cool and fun products such as our podcast, which we published our latest edition this week, in fact, and we've got a lot of other things coming up in the works for 2019. RapNet is important in trading network. It's the biggest diamond trading network in the industry. We have our diamond grading and certification services, and then of course the Rapaport auctions and trading services. Those are the 4 sort of core business units in the Rapaport group. We the Rapaport Information Services launched the Rapaport research report. I think I'm going to say Rapaport a lot of times in this webinar, so bear with me. But the research report we launched in January of this year, and again the idea was it was after getting some feedback from our partners in the industry that they wanted a more in-depth knowledge of what's going on in the trade, as well as a deeper understanding of the data that's coming out of RapNet. So this week we're publishing our October edition, looking at that provenance issue. As I mentioned, it's our 10th edition. And the research report is divided into 3 sections, essentially. The first is the editorial content that we provide, which looks at a theme that's affecting the market on a deeper level. Our last 3 editions looked at the rough market, De Beers company, and what their strategy is looking like. And our last September edition was looking at China after the Hong Kong show. So our second section in the report is our global market analysis, where we look at what's happening in the rough, polished, and retail segments of the industry in the last month, as well as sort of highlighting some of the news and trends, general trends that were sort of prevalent in the market over that month. And then finally, the third section is a detailed analysis of diamond prices, presenting data, our proprietary data from RapNet on supply and demand trends that we're seeing across our 4 main size categories. That's the 30 pointers, half carat, 1 carat, and 3 carat. And these pages that you see on your screen is what the price analysis pages look like for each category. So what is happening out there in terms of diamond prices? We use our RapNet Diamond Index as sort of our flagship index, and we call it the RAPI. And we're seeing that that there has been some softness in the third quarter, but that's after a fairly positive first half of the year, where we saw some impressive gains, especially I think in the 30-pointers. But then we've seen quite a dramatic correction again in the third quarter through October. And so for the year to date, our 1 carat Rappi is still up 1.5%. The 3 carats is stable, flat for the year so far. The half carat is up 4.2%, and the 30-pointers are still up 3.7%. That's an overall index for each size category. When we look at the quarter, this was a theme that we kind of harped on in the July webinar, where we saw the Rappi index for 1 carat increased in the first and second quarter, and there were stronger increases than we've seen for those periods in the last 7 or 8 years, since 2011. And although we saw some declines in the third quarter, I'm going to make that same point, that sort of looking on the bright side, the decline in the third quarter of the 1 carat Rappi was softer than we've seen in the third quarter in the last 6 or 7 years. So I'll take some encouragement from that, and I think it has to do with a lot of the strength of the first half, and some of those factors that we mentioned at the beginning of the webinar about engaging with millennials and being better prepared for some of the challenges that the industry is still facing. But in context, it is true we are in an overall downward correction, since that is still stemming from the 2008 downturn crisis. We had a peak period in 2011, which was a bit of a freak year, but certainly there's been a correction that the market's been in over the last since then. And I would say that we're not out of it yet, and that certainly continues. So what has influenced the slowdown in the third quarter? The third quarter is generally a weaker period for the industry, but I have identified some other factors that I think have had an influence on trading. So seasonality is one, where the third quarter is when dealers take vacation over the summer school holidays. The US-China trade war has fed some uncertainty into the market. And then, of course, the weaker currencies in China and India in particular are having an impact on the trade, and at least on sentiment in those markets. So I'm going to spend the next few slides just dealing with those, with each of those factors, so that we can gain some understanding or insight into what's happening. The seasonality of the industry, I always kind of get a bit of a kick out of it. The cyclical nature of the diamond trade. You know, when I look at an archive of news and analysis that we've done over the last decade, you see the same themes repeating themselves at the same time of the year. I mean, it's in addition to the same news items coming up, or say a company reports on a certain schedule that repeats itself over the years, there is a sentiment that repeats itself at different times of the year, and that's really, I think, starting off with the fourth quarter. That the fourth quarter is a strong selling period at retail. The trade relies very heavily, I would probably say too heavily, on the fourth quarter Christmas season in the United States. And after the fourth quarter, the jewelers come back to the market in the first quarter, at the beginning of the year, and replenish the inventory that they would have sold in the holiday season. That creates some trading dynamic in the first quarter amongst dealers and manufacturers, and which feeds into a positive sentiment generally that we feel in the first quarter. And then after that restocking, or as that restocking is taking place, there's sort of a shift to focus on manufacturing in the second quarter and understanding what retailers might need in the second half of the year. And so come the third quarter, the dealers and manufacturers are generally filling those orders, and there's generally a buildup of inventory, of retail inventory. So even though the third quarter might be slow on from a dealer point of view, it seems to me that there is still a lot of goods are still being shipped to retailers, even though it's not a trading dynamic. So as an analyst or someone or a third party that covers the industry, it's kind of fun when the data backs up this this sort of scenario. So I want to present some of the data that will show this seasonality in action. So beginning with the rough market. India is the most important, as everyone knows, is the most important manufacturing center of rough diamonds. And I think that there's an estimated 90% of goods are manufactured, cut and polished in India. So its rough imports to India give us a good indication of what's happening in the volume of goods that are coming to the market and coming to the factories for polishing. And so we've seen historically over the last 6 or 7 years that India's rough imports tend to peak in the second quarter. And that's been pretty consistent actually until this year, funnily enough. I think that's a demonstration of the weakness in the small stones, that there seems to be an oversupply of goods in the market that we'll touch on a bit later. But generally, the second quarter, as we mentioned earlier, is a period of rough manufacturing, or when rough manufacturing maybe ramps up. And then following that, as rough manufacturing increases, you would expect that the third quarter or the months that follow would see an increase in India's polished exports. They're exporting the goods that have gone through the factories, and so we do see that. And the seasonality of India's polished export and the first quarter actually, which is understandable as that stock replenishment comes through, but the third quarter is generally a strong period for India's polished exports, and I would imagine that a large proportion of those goods are going to the United States, because when we look at the seasonality of the US market and the consumption that takes place there, retailers need to prepare their inventory in the third quarter for the fourth quarter holiday season. And we see that quite effectively in our next slide, where we look at Signet Jewelers. It's a publicly listed company, so we have access to their reports, where they are showing that in the third quarter their inventory tends to spike, and we would expect that to continue. Just a note, Signet reports their third quarter ends at the end of October. So it's really on the cusp of the beginning of the holiday season that we get these numbers for the third quarter. But it's just, I guess, nice to see how that seasonality plays out in the data. What's interesting in this graph, just as a side note, is that there's a general, very slight decline year on year that we are seeing in Signet's inventory, and I think that's reflects what's happening in the overall jewelry retail sector, that retailers are managing their inventory more efficiently. They need fewer goods, and they're able to hold fewer goods in the store because they're able to tap into their inventory of their suppliers more efficiently, given the online or through the different technologies and programs that are available that are available today. So retailers don't want to hold, the less inventory that they can hold, the better, because it also minimizes their risk. And we're also seeing them take more goods on memo, which is a trend that's taken hold at the moment ahead of the holiday season. So that second factor in the market is the trade war. And that's really intensified in the second quarter, and so in terms of sentiment, a lot of that caution that we've seen in the third quarter stems from the uncertainty that people have over the effect that this trade war is going to have on jewelry sales, particularly in China over the Chinese New Year period, which this year takes place in February. So we saw some of that caution at the Hong Kong show. The Hong Kong show was a bit of a disappointment this year for a number of factors. Usually the September show kind of gives the trade a bit of a boost. You know, after the slow seasonal sluggishness of the market in July and August, comes to mid to late September, people look at the Hong Kong show to really get activity going again. And I think the big takeaway this year was that nothing really changed at the Hong Kong show. There was the same sort of caution and slowness of trading that we had experienced in the previous months. It was unfortunate timing this year. Apart from the Jewish and Jain festivals that coincided with the show, which forced some Jewish and Indian companies to miss 1 or 2 days. It was also hit by a typhoon, which forced the organizers to shut the show down a day early, and that would have been that's usually its busiest day. So the show was unfortunate. But in talking to retailers in Hong Kong, the one message that I got was that they've had a very good year in the last year, where they've had double-digit growth. But they said moving forward in the next 6 months, which includes the busy calendar fourth quarter and first quarter next year, which encompasses Christmas and Chinese New Year, they don't expect that same pace of growth. They don't expect that same double-digit growth that they've had last year, albeit that they expect growth, which I think is good enough in a way. But it does add to the caution, and their explanations were because of those geopolitical factors and economic factors, such as the weak currency that might have on consumer spending. That said, last week we got some very positive numbers from the major jewelers in Hong Kong. Chow Tai Fook and Luke Fook posted very good growth for the second fiscal quarter. That's the 3 months ending in September. They continued at double-digit growth in Hong Kong, and around 5 or 6% in China. And at the same time, over the Golden Week and at the beginning of October, there were all indications that tourist traffic to Hong Kong from mainland China continued at a pace, although it's yet to be seen whether their spending was affected by what's going on globally. And of course, what would affect their spending would be the depreciation of the yuan to the dollar. That the currency is at about 6.9 to the dollar. Today, it's depreciated by some margin since it started the year at around 6.5 to the dollar. And this week, Goldman Sachs said it expects to break through the seven yuan to the dollar mark within the next 6 months. So the outlook on the currency is not necessarily positive, and that has an impact on the trade. Firstly, it impacts the spending by tourists in markets such as Hong Kong. but also in markets such as New York, Paris, and London. The major luxury, I would expect the major luxury companies such as Tiffany and LVMH, Bulgari, Cartier, etc., who have exposure to tourist spending, would be keeping an eye on these currency movements and how it affects spending in those markets and at those important touristy type of stores. It also makes products more expensive inside China. Jewelers import many of their materials, and they're paying for inventory in dollars, and subsequently selling it in local currency. So they need to raise prices to make up the difference. And so that's an aspect that we'll maybe be looking out for, if prices at a retail level are increasing in China, and the effect that might have on consumer spending. So that's in China. In India, the depreciation of the rupee has been more extreme even. The rupee's lost about 15% this year, and that affects the dealer market as well as as consumption in India, and that's fed into a lot of the caution that we've experienced this year. When we look at this graph over here, we're plotting the blue line, which is the 1 carat Rappi, which has increased, as we said, 1.5% since the beginning of the year. And if we plot the Rappi in rupee terms, then the increase has been 15%. So the difference is what the trade would need, what dealers in the local market and supplying the local market would need to make up. So it makes goods a lot more expensive there, and that's affected the Malay market in particular this year, where we've seen some weakness in demand and trading of smaller goods. Here we've seen that there has been a general downtrend of Malay prices in the last number of years, but we feel that it has accelerated this year, and there's been a shift away from small goods towards larger goods, more expensive goods. And we see this in India's trade numbers, where the average price of India's polished exports hit a record level in the third quarter. At the same time, its volume of exports actually declined. It was the volume of exports for the year to date in the 9 months is down 10% in India, and yet by value the exports are up 8%. So that gives us an indication that those high volume, low value goods are less prevalent in the market, and there's a shift and that's caused a shift towards the certified goods. Similarly, we had a report this month by Al Rosa that said that the average price of their gem quality rough sales increased this quarter and this year so far, and that's again because there's been a shift in focus to the bigger sizes. So what are those factors affecting the Malay markets? As we mentioned, there's the weakness in India, not only due to the currency decline, but the trade is also sort of reeling from the Nirav Modi scandal, which defrauded a bank in India of $2 billion, and constant rumors of smaller companies seeking bankruptcy protection. Has fed into the weaker sentiment that we're picking up out of India. We also feel that that manufacturers were holding a lot of stock at the beginning of the year in Malay. Last year, 2007, was a very strong year for production, for diamond production. There were 3 new mines that came on stream, and production actually peaked. And so there is a feeling that at the end of 2017 there was an oversupply of diamonds to the market, and that would be sort of weighted on the smaller stones. And then Everyone's favorite topic, the lab-grown diamonds. We can't ignore that that the smaller stones are more susceptible to in their market share to the lab-grown story. And there has definitely been a growth in demand of lab-grown diamonds, and that would affect the smaller stones more than it would the larger stones. I would like to just spend a minute discussing the synthetics. This because it's been a significant quarter for the lab-grown market, as De Beers started selling their Lightbox jewelry line. But De Beers aside, we are seeing that demand for lab-grown diamonds is on the rise, but at the same time we're seeing that prices have softened, which doesn't always make sense, because you would expect as demand increases, prices that would support prices. So the question is, if the De Beers announcement where they are setting a standard price for their synthetic goods at $800 a carat is having an effect on prices. My feeling is that it's too soon or it's too early for De Beers to have a wide impact on the market. I think rather I think we can't discount that it might have so in the future, but De Beers is at very early stages of production or early stages of selling production, let's say. What I think is influencing prices is supply. I think there's an increase in supply of lab-grown, and there's also an increase of suppliers in the lab-grown market. So there's more activity in the wholesale dealer market, which is bringing more competition that would create more friction on prices. And I think that's an interesting development. Maybe that's an effect that De Beers had on the market, is that it kind of gave a green light to others to enter, and dealers are looking for ways to be more profitable in this business. This is more of a suspicion of mine, that at the retail level, the jewelers are cautious about dealing with melee, and because it requires such thorough testing and screening, which is very accessible at the dealer level. All the bourses have service centers which offer screening and testing at affordable prices, but my feeling is that the retailer needs to do its own testing as well, and needs those guarantees that might be a bit too much of a hassle for them. So I'm wondering if that's having an effect on the market. So that's melee. Melee was has been one important story in the industry this year. The other big story for the quarter has been the movement in 30-pointers, and it really has been a roller coaster ride for 30-pointers in 2018. As I mentioned earlier, the RAPI for 30-pointers really increased significantly, or nearly 10% in the first half of the year, but we've seen a decline of about 6% since then. I think part of the story is that the 30-pointers is a Chinese item, that it's a popular item in China, and so I don't know if it's coincidence that the caution over the trade war developed in the third quarter, and 30-pointers weakened. I don't, but I think maybe it is playing into it. I think what's probably more true is that the Chinese retailers were restocking in a significant way in the first half, and they probably have enough of these goods at the moment, which has caused a pullback in prices. But when we look at RapNet, when we analyze some of the data that we present in our research report, and this is our snapshot for 30-pointers that many of you will receive in the coming day or two of our current report, we are seeing some interesting factors. Firstly, that that inventory of those lower colors, L2M colors, has increased significantly. And that's as of October 1st, and it's compared to the average of the previous 3 months. That's generally the presentation that we give. in the report. Other sizes have had, or other categories have had different inventory movements. For example, the D2H inventory has in fact dropped quite significantly in the SIs. But across the board, we're seeing that that prices have changed in various categories, or have come down in various categories. So I want to look at the data, and I'm not going to be looking at specific categories, which we did last time, but I just want to give you an indication of where in the report you might be able to find this information, that you can sort of go back to your offices and play with the numbers and come to some sort of understanding of what's happening in each specific categories you might be interested in. This is our the third page, our demand page of for each category. We present the inventory at the beginning of the month, at the beginning of August, and sales of August. It's a few months back, because we need to analyze sales on RapNet. We need to give the stones time to go through the system, which would be at least 3 months. So it needs to be. We wouldn't be able to present say that October data now. Anyway, so we focused on August for now, where we show the sales volume, the inventory volume, the average sales price, and the discounts and the changes in volume during the month. That's a bit easier to read, some of those quadrants that I'm going to be showing you in the next couple of graphs, because I want to show you that, or we want to have a look at inventory and sales levels in the total category, to get an understanding of why it's been so weak in the quarter. So in this graph, the blue bars are inventory at the beginning of the month, and the orange is the sales volume that took place during the month. And actually, when you look at the 30 pointers compared to last year, sales volume is up, yeah, so sales volume is up, and sales have been fairly consistent actually in the last 6 months or so. But when we look at inventory, we're seeing that there's a lot of inventory on the market, far higher than this time last year, and in fact far higher than we've seen in the last year and a half, in the last 2 years. So if we want to understand the proportion, how much of inventory that's available on RapNet is sold during the month, that would be a powerful indicator of what's happening in the market and the trend over the month. So so we've taken that data and understood that as a percentage of inventory, how much sales were made as a percentage of the available inventory. And so in August, we saw that that it was 52% of goods that were available on RapNet at the beginning of the month were sold subsequently during the month, which was significantly higher than August last year, but it was also significantly lower than in January. When we saw such a strong after which we saw such a strong price increase. That February drop was because prices had increased, and I think people were sort of trying to feel out the market to see what was really happening, and if those prices were going to stick. They did stick, and so in March we saw the percentage of inventory that was sold spike up again to 60–70%. Now we're back down to 52%, and there's been a steady decline in the second quarter, which would have contributed to the softness in prices. And here we see that softness. We're plotting here that percentage of inventory that is sold against the RAPI index for 30 pointers, and you can see as the percentage of inventory sold increases, so it supports prices. As it decreases, prices soften, and we're definitely on a downtrend now. I'm gonna rush through the next few slides because I want to give you time to ask some questions, and we are running a late. So so bear with me, and remember to please write any questions in the Q&A section of the Zoom facility. So that was a 30-pointers, and in contrast, we can look at the one caraters, and the one caraters are 30-pointers, largely because of the volume of goods. The smaller the stone, the higher the volume that is brought to the market. So this is the one carat Rappi. You'll excuse the headline; it's actually not correct. It should be 3Q stability in the Rappi. But we see here again that we had some strength in the first quarter and some stability and support of those in the third quarter. But overall, it's been a pretty steady category for the industry. When we look at inventory against sales, we see that stability again. That the sales made during the month, which is the orange bars, has been fairly consistent, and so has inventory, barring January, which I think in the fourth quarter here we see comes into the retail market. But manufacturing comes again, and we're seeing some stability in the inventory levels. And when we look at sales as a percentage of inventory, interestingly, the one caraters are lower than the 30 pointers. If you remember, in August, the percentage of 30 pointers on RapNet was sold was about 52%, and that was a low. Here we're seeing that the one caraters, it's the point that's in the 30 pointers. You see the fluctuation. You might see a much wider range of movement. You know, it can be 70%, 73% of goods on RapNet that are sold in the 30 pointers in 1 month, and 40% in another month. In the one caraters, it's much more stable, and it peaked at 53% in January, and it's down now to 41%, which is probably why we're seeing a little bit of softness in the third quarter of these. So it's an interesting contrast between the one caraters and the 30 pointers. But what does all this data tell us about the coming months? What can we read into the data that's presented in the research report to understand how the industry is going to evolve in the November, December, January period? So firstly, we have available two variables on RapNet that we can present to you. That's inventory and our price trend. We can't present to you our sales trend because we haven't, as I said, we need to give the goods time on RapNet to go through the market and make sure that they're not repeating themselves on the trading platform. But what's interesting is that in September and October, inventory of 30 pointers continue to rise. And I would imagine that the percentage of sales to inventory will continue to decline because of that increase. And we're seeing that prices have continued to soften on the 30 pointers in September and October. My question to the trade is really why and who is manufacturing all these goods? And it's not just you know, you can argue that you got the holiday season and Diwali coming up where factories are going to close. But if you look at inventory in October 2018, where we are today, and October last year, it's close to double even. And I think it's a really interesting question of why are manufacturers buying so much rough? My feeling is that they don't necessarily want to. There is a pressure with the banks and also the suppliers of rough to satisfy credit lines and show that they need the goods to ensure future supply. But it's an interesting fact, and obviously as inventory increases, prices will naturally soften. So it's understandable why we're seeing that softness in the 30 pointers. At the last webinar, we spoke about relative inventory, which indicates the amount of stock available, and if that amount of stock is available, is sufficient in relation to what the market is demanding. So it's calculated by using inventory as a proportion of sales turnover. So if we take the sales that are made on RapNet in a month and divide it by the number of days in the month, we'll get an understanding of sales per day. So in this example, which we used in the last webinar, there were sales of 482 of this category stone in May, which translated to 16 stones a day. And then we looked at the inventory that was available, and there was 990 stones, which meant that 990 divided by 16 days means that there's 62 days worth of stock available in the market. So if we look at that calculation in the 30 pointers, and because we don't have the sales data for September and October, I used the average for August and applied it to the inventory in September and October. We see that that the industry has enough inventory at this point in time to satisfy 80 days of demand. It's just another way of looking at inventory relative to sales, and I think it's something for the industry to keep in mind if we are overstocked going into this fourth quarter. In contrast, we'll look at the Rappi the 1 caraters, where again inventory is beautifully stable, and the Rappi index is a bit misleading because it shows some volatility, but the axis is more tight, and there is some softness, but that has continued in September, October, and that's with a slight increase in inventory, and the relative inventory on the 1 caraters using that same calculation based on August sales and September, October inventory, we're seeing a slight increase and some stability again in October. And it's again that the market has, based on RapNet inventory, there's enough goods in the market to satisfy 70 to 80 days of demand. And so what are those 70 or 80 days of demand? And that's really, we're basically looking at till the end of the year. And it's important to know that in the next week or two, there's the Diwali festival. The Indian manufacturers will be closing their factories for up to 3 weeks. Some of the smaller manufacturers, I understand, are closing a bit early because of the weakness in the Malay market. And so, in a way, the industry needs additional stock to see it through the next few months. But as I mentioned earlier, relative to where we were last year, there seems to be an oversupply of small goods in the market, both in Malay and the 30 pointers. That is putting the small to medium-sized manufacturers under pressure. They're under pressure from the weak rupee, the bank caution, and those the rumors of bankruptcy is feeding into some weak sentiment. And I think they'll welcome that break from manufacturing in November. And then we go into the holiday season as we hit Black Friday, Thanksgiving. There's Singles Day on the 11th of November in China, which is becoming an interesting selling opportunity for companies, not only in China, but also in the trade. And there is still some optimism. We have reason to be optimistic for the holiday season in the US. I would say there is some caution about China, that the trade war and currencies are affecting the outlook for growth over the Chinese New Year, and that may affect restocking in the first quarter. But overall, it really is a question of how much of that inventory that's available in the market today will be still available or used up over the next coming months. So that's my little shtick. Thanks very much for listening to me for the last 50 minutes. I went over time a bit, but I'd love to take your questions. And as I say, if you have any questions, you should write them in the Q&A facility on Zoom. So do we have any questions, David? There are no questions at the moment. While I'm doing that, I will say that that I would love to hear from you. I'd love to hear feedback about the webinar. I'd love to hear feedback about our research report that we publish on a monthly basis. And I would love to have a discussion with you just generally about the market. If you have any questions or advice or your take on the market, not only myself, but also Shimon and others in our different offices around the world will be only too happy to get your take and your feedback about the market. And you can contact me at avi.kravitz@diamonds.net. I'm on Twitter at Avi Kravitz. I'm even on OkCupid and Tinder. That was a joke. Anyway, so I'll take a question here. So Rahul says, can you please restate the number of stones sold per month for 30 pointers and others? Sure. So let me just get back to that slide. And it's just an indication, really. But the relative inventory, sorry, that wasn't the question. The sales on RapNet for 30 pointers, and that's this slide here. We have it, and it's in August. We don't have the sales for September, October yet, but it was was close to 40,000, just under 40,000 stones was sold on RapNet in August. It varied between 30 and 40,000 from March to August. And we're seeing that they're close to 75,000 stones in August available on RapNet. We'll look at the 1 caraters, and that information is on the research report that you might receive. On that 3rd page, that we divided into different size and color and clarity categories, but you can do the calculation. On the 1 caraters, generally sales fluctuate between, I'd say, 12 and 15,000 carats per month. And inventory in June, July, August was at around close to, I'd say, 29, 30,000 stones. So Randy has an interesting question. How do we share true information relevant with trade members to dispel misinformation given out by synthetic diamond promoters? Well, firstly, I think we can really just be confident in our product, and sometimes the insecurity about synthetics kind of, for me, demonstrates insecurity about our own product. I think we have a beautiful natural diamond product that we can talk about the positives about the product itself that would influence anyone to buy a natural diamond over a synthetic diamond. The Diamond Producers Association published in the last week or two, and in fact it's in the Rapaport magazine this month, where they give 5 truths about the natural diamond industry, and 5 truths about truths being TRUTHS, if you didn't get my accent, about the synthetic diamond industry. And that's I wish I had it in front of me, but there were some interesting tidbits about that, including there were 1 or 2 points in the we discussed it on our podcast this last week, which actually we published today. One of the interesting questions that the DPA asked was the synthetics producers don't ever disclose which factory the diamond came from, the lab-grown diamond came from. Now, the natural industry is doing such amazing work to show the provenance of a stone. You know, there's the GIA's mine to market program. A number of the manufacturers have developed tracking programs. There's the various blockchain systems that are in place, and all to tell a better story about the diamond and to show that it's a trustworthy product. And the synthetics guys tend to go on a negative sort of angle when it comes to their marketing. But it would be an interesting question to ask them. What you know, where is that stone from, and is that factory adhering to RJC standards, for example? And so these are different things that you can focus on. But I would encourage you, and Randy, you can certainly email me. I'll be happy to forward you that those points that that document that the DPA published this month. That it's I think well worth a read. So Rahul asks, when would we get the research report that I mentioned? The answer to that is today or tomorrow. If you're a subscriber to the research report, we are putting the finishing touches to it as we speak, and we will be publishing. We'll be publishing today or tomorrow. So I understand that there is a question in the chat. How do I get there? So, David, do you mind reading me the question in the chat?
Nina asks, could you please share views on larger stones outlook? You spoke about 1 carat and smaller stones, but what about big ones?
By big stones, I guess it's 3 carats, 5 carats, and up. So firstly, on the 3 caraters, we are seeing some stability in the 3 caraters. In general, sorry, where is that? There we go. So the yellow graph over there is shows some stability in those 3 caraters. But generally, the larger stones are stable. We are still seeing good demand at the auctions for very special, beautiful stones. Those are the high-end auctions, such as by Sotheby's and Christie's, and there's some beautiful pink diamonds that are expected to break records at the November auctions. But overall, the larger sizes are fairly stable, and yeah, I guess that's all I have to say about that. Okay, so Joshua asks, how long will it take for lab-grown diamonds to become a common engagement ring product? Well, firstly, I think there are consumers who are looking at lab-grown as an alternative, as a cheaper alternative or more affordable alternative to for an engagement ring, and I understand there are jewelers and wholesalers and retailers who are developing lab-grown lines. A celebrity came out. I forget her name. It's Nikki Reed, is it? I believe that's her name. Had an interesting interview, in which she's all about sustainability, and she's developing her own line of lab-grown engagement rings. So it's something that it's a smaller segment. It has a smaller market share than the smaller goods, but it's something that we got to be aware of. And the bigger question is if at some point in the future De Beers will enter that market on the lab-grown side. And time will tell. They'll say they won't. They are saying that they're not. They don't have plans to. But I would say never say never. So Randy has a response to what I spoke about. I'll read it through. I don't think there's a question in there, but I'll read it out aloud. It says that after recently reading a blog from a well-known lab-grown diamond producer about diamond formation, I would agree about one thing. Given the right conditions and sufficient flux of nutrient carbon, naturally occurring diamonds can grow to gemological size in hours or days, faster than the lab processes. This is what the synthetic diamond industry has learned. They are incorrect to say that natural diamonds grow in hours based on the rates of in-lab growth, because both rely on a sufficient flux of carbon. In the Earth's mantle, carbon is present at part per million levels, and it may take eons for sufficient carbon to diffuse to a site of crystallization to form a natural occurring gemological diamond. I think part of the romance of a natural diamond is the amount of time it takes to be unearthed. I love the romance of having a stone that's steadily crawled its way out from the core of the Earth's crust, and through man's ingenuity, we figured out a way to dig them out the ground and to make this rough diamond that's been through so much into such a beautiful polished stone. So I'm not sure if speed counts. I would say that the efficiency at which a lab-grown diamond can be produced might lead to the undoing of the lab-grown trade, because they are increasing their production, and that will lead to an increase in supply, which will pressure prices downward, and that we've, as I mentioned earlier, that we've seen already in 2018. What is the outlook for the industry for 2019? It's a good question. I think the we're going to be dealing with a lot of the issues that we've outlined already in this webinar. That much depends on the US holiday season, which I think is we have reason to be optimistic for the holiday season, and that should have a trickle down effect for 2019, the first half of the year. I don't. Again, I think we can expect some caution out of China. So for the Chinese New Year, that may affect some of the restocking out of the East, going into the the second quarter, I would say. But generally, I'm quite positive for the markets in moving forward, and it's again because I think we're more geared to deal with many of the challenges facing the industry, and there are many challenges. I think 2019 will be an interesting year for the development of lab-grown diamonds and how that will affect the natural trade as well. But I think we have what to be positive about. Sanai asks, how do you calculate average discount and price in the research report? Well, we don't calculate it. I see. So firstly, the average discount in the research report is there are two price points that we are presenting in the research report. The first is the average discount for RAP that we get from, and that's the average asking price, which is taken from RAFnet, and it's
it's information that you'll see on RapNet. When you go onto RapNet, you'll see the asking price that a seller is requesting, and that's where the start of negotiations. That's what starts off the negotiations on RapNet, and so we take an average of the asking price on RapNet and present it in the research report, and it's the average asking price of the top 10% of goods that are on RapNet. So it's not an overall average; it's a top 10%. In order to discount for extremes, essentially. The second price point that we present is is on the demand side, that we're looking at the sale on the average sales price of goods on RapNet, and that's an average of the total sales that have taken place through the RapNet platform. If you have any further questions, please put them in the Q&A section. If you have any questions, again, our goal is to increase the conversation with the trade, and so I welcome any feedback about the webinar, any feedback about the research report, and any feedback about the market. To my email, which is on your screen at the moment, avi.kravitz@diamonds.net. I'm also on Twitter, which is @avikravitz, and I'd love to hear from you. We also, and that's not only me, but it's also our representatives from our offices around the world. Often people ask where we're getting our information from, and really it's from so many different sources, including our trading on RapNet, the trends we're seeing in news and analysis in our various publications, but most importantly, is through our conversation with the trade, and we're engaging in every part of the world. With the trade to get information about what's going on, and you should know that we meet once a week on a conference call, which we call our price call, to discuss these trends and to get feedback from the different parts of the market. So I encourage you to participate in that through your engagement with our representatives in your market. If you want to learn more about the research report, on the screen there's a subscribe link, but I encourage you to go to info.diamonds.net/rr-research-report-sign-up-2-B, and you'll be tested on that to repeat it to me when we speak later in the week. We have a question from Richard. He asks how do sales volume of 30 pointers and 1 caraters compare to 2011-12 and the pricing peak of the market. So Richard mentioned that he came in a bit late, but I'll try and get back to that graph in terms of sales volume. So let's see if we did have that. We don't have I didn't present earlier the sales volume of for 2011, but I can tell you that in terms of pricing, as you can see on your screen at the moment, Richard, the market peaked in 2011, as you pointed out, and it's come down by about, and this is the 1 carat Rappi, come down by over 60% since that peak in 2011. I think generally, just and that's for 1 caraters. Generally, I I think generally the market's been overstocked with goods, and this is just an anecdotal feedback and my impression that the market's been overstocked with goods, particularly in the midstream, since that peak in 2011. That in the run-up to that, there was very aggressive buying from the Chinese and Hong Kong-based jewelers, and as they expanded very aggressively into China, and that sort of stopped in 2011. One of the lessons we learned from the 2008 crash was that retailers have been much more cautious in their inventory management, and at the same time, but the trade hadn't caught up with that, and so we saw that as the retail market after 2011, also in China and Hong Kong, sort of consolidated and became a more efficient with their inventory management, more cautious not to have inflated inventory. A lot of the inventory was left in the midstream, and so manufacturers and dealers were left carrying the burden of inventory. And I think that's one of the factors that has contributed to this correction that we're seeing, that we've seen in the last number of years. Richard, you're welcome to email me. I don't have the 30 pointers dating the RAPI of 30 pointers dating back to 2011 on this presentation, but I'll be happy to email it to you if you're in touch. So so at the moment we don't have any further questions. So I want to thank everyone for joining our webinar, our second webinar that we've had on a quarterly basis. We'll be doing this again in January, and as I say, we published our research report yesterday. That's available for subscribers, and you're welcome to contact me or any of our office representatives to get your copy, or understand how you can get a copy of that research report. So thanks very much, and I'm going to take one last question that just came in from Robin, because it deals with a topic that we dealt with in the research report. And Robin asks, traceability is becoming increasingly important. Are retailers in the United States starting to embrace platforms such as the GIA Mine-to-Market program? So the research report that we published yesterday asked this question. It asks if there is actually a demand for these provenance programs, for this traceability. And not to give too much away, but there I would say that at the moment retailers are not there isn't a critical mass of demand for these traceability programs at this stage, and that means that consumers are not going into the store in the first on a very wide scale and asking for the provenance of the diamond, but they are assuming that the diamond is responsibly sourced, and so the retailer needs to give that assurance when it's needs to have that or give that assurance, and so while many of these programs are still in kind of a pilot and testing phase, I think that my belief is that they are going to grow in acceptance in the long term. I think it's going to take a while, but they are going to grow in the long term, and it really depends on the retailer how much detail they want to provide their customers with, and how they make that provenance story, that provenance claim part of their storytelling in the diamond. I think it's a very effective tool that retailers can use to tell a story about the diamond and increase sales, and also provide an added service. And the service, the added value is a service, really. I'm not sure if you're going to be able to sell such a diamond at a higher price than a non-traceable diamond, but it's certainly that remains to be seen. But it's certainly a service that's adding value to the sale. I hope that answers your question. Anyway, we're out of time, so I look forward to hearing from you, be it in the coming weeks, or at the next webinar. So thanks for joining us, and appreciate your being here. I hope this helped. Take care, everyone.